Here is a contradiction that looks like a mistake. The same group of foreign investors that has been pulling billions of dollars out of Indian stocks just poured a record amount of money into Indian government bonds, selling the equities with one hand, buying the bonds with the other, at the very same time. It is not a mistake. It is one of the clearest examples of how two doors into the same country can send completely opposite signals. This is the story of India's bond paradox, and what it reveals about the difference between hot money and structural money. Here is why this matters. Foreign money enters India through two very different doors. One door is equities, where foreigners buy and sell shares. The other is debt, where they buy government bonds. For years, people watched only the equity door, treating foreign selling of stocks as a simple thumbs down on India. But in the first half of this year, foreign investors yanked roughly 2.7 trillion rupees out of Indian equities, while at the same time buying government bonds at the fastest pace on record. If you only watched one door, you would completely misread the story. The paradox forces a sharper question. What makes money leave through one door and rush in through the other? Let's rewind and see what changed on the debt side. Three things flipped the switch. First, India was added to major global bond indexes, starting with JP Morgan's. When a country joins one of these indexes, funds that simply track the index are obliged to buy its bonds, whether they personally like the trade or not. Second, the government gave foreign buyers of certain sovereign bonds an exemption from capital gains tax, which sweetened the deal. Third, it widened the so-called fully accessible route, the pool of bonds foreigners are allowed to buy without limits, even opening up 30-year debt for the first time. Put those together, and you create a powerful new source of demand that does not care much about the daily mood. So how does that reshape the flows? Here's the machine. Think about what index inclusion really does. A global bond index is like a recipe that thousands of passive funds must follow exactly. When India gets added to the recipe, every one of those funds has to hold Indian bonds in the right proportion, or it fails to track the index. That buying is mechanical. It is not a bet on where yields go next week. It is a rule these funds must obey. So a large slice of the foreign bond demand is now structural and price-insensitive, a steady buyer that keeps showing up. Contrast that with the equity door, where most foreign flows are discretionary. There, a fund manager can wake up nervous about global growth or valuations and sell tomorrow. So the two doors are driven by two different kinds of money. Rule-bound money buying the bonds, mood-driven money leaving the stocks. Same investors, opposite behavior, because the rules on each side are completely different. Here is where it gets concrete. In June, foreign investors bought about 39,600 crore rupees of Indian government bonds through that fully accessible route. That is roughly $4.2 billion in a single month, and it beat the previous all-time record, set back in 2024, by around 80%. All of this while the 10-year government bond yield sat near 6.75%, calm and steady, even as foreign money was fleeing equities. And on the domestic side, homegrown institutions kept buying stocks, cushioning the exit. The people who feel this most are ordinary savers, because a calmer bond market helps hold down the government's borrowing cost, which ripples out to loan rates across the economy. A quiet flow through the debt door ends up touching everyone. So here's the lens to keep. Foreign flows are not one thing. Some of it is sticky, structural money that follows index rules and tends to stay. Some of it is fast, discretionary money that can reverse on a headline. The bond paradox is really the difference between those two kinds of capital showing up at the same time. When you see foreigners selling Indian stocks, do not assume the whole country is being abandoned. Check the other door. And when you see record bond inflows, ask how much of it is rule-bound index money versus opportunistic money that could leave just as quickly if global conditions turn. This does not tell you what happens next. It just helps you read which kind of money is really moving. This channel explains how markets work. It is educational, not financial advice.